pouring your life into a business, 5 million in revenue, solid profits, a buyer waving a 10 million check, and you're inches from the finish line, from freedom, wealth, maybe the huge mansion you always wanted. Then financial due diligence hits. One sloppy mistake, maybe uncontracted client, or hidden debt, and your deal dies right there. I've watched 50 million in deals vanish like that within weeks. I've run over 200 due diligence reports in private equity, acquired dozens of companies, and coached founders to $1 million exits. And today I'm spilling the deal-killing mistakes I've seen destroy great businesses and the exact steps to bulletproof your sale. If you're planning to sell, this video could save you millions. What is FDD? Financial due diligence. In private equity, due diligence is the buyer's final test for you. It's like tearing apart your revenue, profits, and contracts to prove they are real and not just a polished pitch deck. Why so brutal? Because no buyer risks millions on trust alone. I've seen founders think it's just a checking of the books exercise. Wrong. It's a 30 to 90 day brutal audit to verify your business value, uncover risks, and answer what's this really worth and what could screw us in this business. Now, buyers like me use due diligence to negotiate. Find a flaw and we'll slash your price, like 10 to 30%. Valuation cuts are standard. I once diligenced a $2 million tech firm and inconsistencies dropped it to $40 million. There was another deal where a $15 million offer tanked completely over a single red flag. But here are the good news. Every mistake is avoidable. Let's unpack the top 3 deal killers I've seen across 200 plus diligences and how you can fix them to save your exit. These are the mistakes that cost sellers millions, straight from my deal files. Mistake number 1, no contracts. I diligenced a $12 million B2B agency business and 40% of their revenue came from one client. No contract, just a handshake. To me, that income was a mirage. If that client walks post-sale, the deal value collapses. I've seen 10 million exits die over this. Another case was a SaaS founder who claimed 3 million in recurring revenue, but half of that was a verbal agreement. Buyers don't pay for promises, they want solid contracts. Here's your step-by-step action plan to lock down customer relationships. Step 1, audit your client base today. List your top 20 customers and check they are locked in by contract, not just a handshake. Step 2, prioritize your top 5. If 30 to 40% of revenue comes from a few clients, lock them down first. Step 3, aim for 2 to 3 year agreements, even 12 months terms without the renewables. Step 4, add a diversification plan. Show buyers you're not over-reliant on one client or one sector. I coached a founder who secured contracts a year before selling. The 8 million valuation held firm without any cuts. So pull up your revenue sheet right now and ask yourself, if my number 1 client leaves tomorrow, could I still sell the business for what I want? If the answer is no, your exit is already at risk. Now, mistake number 2, number chaos, inconsistent books. Picture this, I'm reviewing a 7 million logistics firm. Their P&L screamed record profits, but tax returns showed losses. The balance sheet was a puzzle. To me, it looked like they didn't even know their own business. That's an instant deal breaker. Buyers like me need clean, aligned records of profit and loss statements, balance sheets, tax returns, and debt schedules. Mismatches simply raise alarms. I've dropped offers by 25% for this, and one seller lost 2 million because their numbers didn't add up. Buyers like me need clean, aligned record of profit and loss statements, balance sheets, tax returns, and debt schedules. Inaccurate books or mismatches simply make buyers walk away. They don't have time to tidy up your books. So how to fix it? Step 1, hire a professional accountant right now, not your cousin who knows QuickBooks. Get someone who's done M&A preparation. Step 2, reconcile every record. Align your P&L, balance sheet, and tax returns for at least the last 3 years. Step 3, adopt software. Use QuickBooks, Xero, something buyers trust. And step 4, run mock due diligence exercises. Ask your accountant to stress test your books before a buyer ever sees them. Try cleaning your books up for 18 months before selling. I worked with a founder who did this, and when the buyers came in, his financials were spotless, resulting in closing the deal at the full $10 million valuation. Because clean records aren't just a defense, they signal you're a pro protecting your price. And so check your P&L right now. Does it match your taxes? Does it make sense overall? By the way, if you're enjoying this video, smash the like button below to help my channel grow and bring you even more insider tips. Now, mistake number 3, mystery profits and unexpected gains. I Diligence tech startup with a sudden 50% profit spike. Looked amazing until I asked why. It was a one-time client deal, not repeatable. So the valuation multiple is very different on that number than in a recurring revenue, for example. Another seller had $300,000 in miscellaneous expenses with no receipts, and buyers simply assume unexplained numbers are flukes or fraud, so we cut valuations. I've seen $5 million shaved off a deal like that. All right, how to fix that? Build an add-back tracker, create a spreadsheet logging all owner perks like salary, car lease, one-time expenses like legal fees, consulting, and unusual items. Step 2, attach proof, receipts, invoices, contracts. Try to back up every line in your P&L. Step 3, explain spikes. If profits jump, write one sentence explanations, what was it? So the reader, the buyer can really read your P&L well. And then step 4, update monthly. Don't wait until due diligence. Track add backs as you go. And in general, of course, your financials. I had a founder who tracked $200,000 in add backs with full documentation. That added $1.5 million to the sale price. Without proof, buyers would have called it a fluff. So you might think buyers are harsh, but we're not just buying your past, we're betting on your future. Due diligence is our crystal ball. Can this business scale, or will it tank? A single red flag can really cost your valuation or even the whole deal. Now, in terms of participants in a due diligence, smaller deals have usually accountants from your side, from the other side, and big ones, like a 20 million plus deal, you have analysts, M&A professionals, even industry gurus, all hunting for cracks in your business. The clock's always ticking, maximum 30 to 60 days for small businesses, 90 days for bigger ones. But here's how to flip this script. Gather key docs now. Have your documentation ready. Keep 3 years of P&Ls, balance sheets, tax returns, contracts, everything well documented. Your numbers will tell a clean story and you won't need to worry about it. Finally, I tell founders to create a one-page summary of revenue trends, margin wins, and growth plans. Use visuals because buyers get it in seconds. And the more you can tell about the future as well with your own assumptions and the market growth, the better that is as well. I've seen $50 million vanish in due diligence. Don't let that happen to you. Whether you're selling or buying a business, my 200 deals proof preparation is your edge. So grab my free ultimate guide on Notion, packed with exit checklists, due diligence lists, every seller and buyer needs to close deals confidently and maximize value. The link is in the description below.